Hi guys. Welcome back to our YouTube channel AQIB TJ. In first part we have discussed about quantitative easing. Now we are covering the topic quantitative tightening. Before we get started, subscribe our YouTube channel for more thoughtful videos. Guys, have you ever imagined if the central bank quietly started pulling trillions of dollars out of the economy? No headlines, no panic, just slow pressure. That's exactly what quantitative tightening is, and it might already be affecting your life. Quantitative tightening, QT, is a monetary policy used by central banks to reduce money supply in the economy. Quantitative tightening happens when a central bank, like the Federal Reserve, shrinks its balance sheet by selling government bonds or not reinvesting maturing bonds. This takes money out of the financial system. During quantitative easing, QE, central bank adds money. During QT, central bank removes money. Why do central banks use QT? QT is used to control inflation, reduce excess liquidity, stabilize the economy. How QT affects the economy? Interest rates may rise. Borrowing becomes expensive. Spending and investment decrease. Inflation slows down. Real example. After the COVID-19 pandemic, the Federal Reserve started QT to control high inflation caused by earlier money printing. Easy one-line definition. Quantitative tightening equals central bank removing money from the economy to fight inflation. Interest rate makes loans expensive. QT removes money from system. How QT affects markets? Stock market. Less money equals less investment. Stocks may fall. Banks. Less reserves. Lending becomes tighter. Currency. Currency can strengthen, less supply. Real estate. Higher mortgage rates. Property demand decreases. QT after COVID-19. During COVID, central banks used quantitative easing. Printed huge money. After that, inflation surged globally. So the Federal Reserve started QT. Goal: cool down the economy. Risks of QT. Here's what actually happens behind the scenes. Step by step. Federal Reserve stops buying bonds. Bonds mature, money disappears. Bank reserves shrink. Liquidity tightens across markets. This reduces the money multiplier effect. QT versus interest rates. Smart content. Most people think interest rates do all the work, but QT works in the background. Interest rates equals visible pressure. QT equals hidden liquidity drain. Together equals powerful economic tightening. What exactly happens during QT? When a central bank like the Federal Reserve does QT, it reduces its balance sheet. Balance sheet equals total assets, like bonds, the central bank holds. It does this in two main ways. 1. Letting bonds mature, passive QT. Government bonds expire. Central bank does not reinvest. Money disappears from the system. 2. Selling bonds, active QT. Central bank sells bonds in the market. Buyers pay money, liquidity decreases. QT versus interest rate policy. Both fight inflation, but differently. This is all about today's topic. Stay connected if you want more useful information like this. Don't forget to like, comment and subscribe.